is Alan Clark. On my right is Dana Alice, Alan Morgan, Jack Gibbs, and Matthew Bennett. We are here to recommend a buy for Family Dollar stock at a 12-month target price of $72.85. We believe Family Dollar is a buy because of their growth opportunities, position in the industry, as well as their valuation. Now, for a quick overview, Family Dollar is a discount retailer based in Matthews, North Carolina. They target families making $40,000 or less in a year, and they operate 7,600 stores in 45 states, which makes them the second largest dollar store chain in the United States. Now, the first reason we recommend a buy is their growth opportunities through store renovation and expansion. Family Dollar currently operates 7,600 stores, with plans to open 500 more this year. We forecast that they'll open 9,500 stores by fiscal year 2017, which is still less than half of what the company believes is a 20,000 store total capacity. We believe that most of this growth will come from the West, especially California.
Now, with these aggressive expansion plans, our team wanted to take a look at where we felt like Family Dollar stores might reach a new store saturation point. In order to do this, we took a look at both Family Dollar and Dollar General's existing stores in each region of the U.S. We then took the population of each of these regions and determined that the southern region was the most densely populated with stores compared to the number of people. We then applied a conservative estimate based on the South to the other regions and determined that the Family Dollar has plenty of room to grow to at least 13,000 stores.
In addition to expansion, Family Dollar's existing stores represent an opportunity for growth with its 8-day renovation program. We were able to visit some Family Dollar stores and tried to capture what we saw, which was a huge difference between its non-renovated stores and its renovated stores. Shopping at a renovated Family Dollar was like shopping at a completely different company. And we are excited about this discovery because of the over half of stores that have yet to be renovated. Family Dollar is going about its renovation program at an aggressive rate, with plans to renovate 850 stores this fiscal year. Not only does this renovation program return value to Family Dollar's customers by improving the shopping environment, but also to the company with an increase in 10% in sales.
The second reason that we feel Family Dollar is a buy is because of their competitive positioning and product mix. We believe one of the keys to Family Dollar's continued success is their retention of the trade-down customer that they gained during the recession. During this time, many higher-income families began to value shop when money was tight. We attribute this to a shift in consumer psychology that has occurred during this time period. We believe the driver to this shift in value-focused psychology is a result of the decreasing level of median household income across the United States. During the recession, as you can see, the median household income level decreased at 4.2%. Since the end of the recession, in what is considered to be a recovery period, it has continued to decrease another 4.1%. We attribute this longer-term decrease in take-home pay to shift in consumer psychology. We would also like to note that the current median level of around $50,000 per household falls within what a Family Dollar's higher-end target customers. We feel that Family Dollar will continue to appeal to these customers through their attractive product mix. The company has shifted towards more consumable sales, which attracts convenient shoppers who may be coming into the store for their weekly grocery visits. The company has also increased their national brand assortment as well as their private label assortment to appeal to all ranges of customers. With rising consumables, there is a concern for margins for the company. However, we feel that Family Dollar is actively fighting against decreasing profit margins by improving their private label assortment with their new distribution center in Utah to access their West Coast expansion, as well as their partnership with McLean to streamline their supply chain process. When taking a look at both Family Dollar and Dollar General, since 2007, as you can see, Dollar General has been able to significantly improve their margins. We feel that if Family Dollar can close on this 2.7% EBIT performance gap, their upside and profitability will be great for the company moving forward.
The third reason that we recommend Family Dollar as a buy is for its defensive stock qualities as well as its attractive valuation. We categorized Family Dollar as a defensive stock based on its performance during the recession as well as during the slow growth recovery period afterwards. During the recession, Family Dollar outperformed the S&P 500 by 58.1 percentage points, generating a return of 21% compared to the S&P 500's return of -37%. Compared to the retail industry as a whole, Family Dollar outperforms again, consistently beating the industry's growth rates. They've been able to do this because of their consumer staple product offerings that are less vulnerable to economic shifts.
We use 5 valuation methods to derive the 12-month target stock price of Family Dollar at $72.85. We relied more on the multiples because we believe that there is a more realistic market valuation for the company's stock. For our discounted cash flow, that was largely driven by a net income compound annual growth rate of 7.7% during our forecast years. That, in turn, was dependent upon our store forecast that we have embedded into our model. We also used a conservative 3.1% perpetual growth rate for our terminal value cash flow. That is significant because that is equal to the 100-year historical average inflation rate. Using that conservative input, we came up with a stock price of $83.90 for our discounted cash flow. For our multiples valuations, we used justified inputs that were greater than the trailing 12-month metrics, though lower than the 2012 averages. The trailing 12-month metrics have been lowered recently due to 2 significant price decreases in the last 3 months. For Family Dollar, we believe that the stock will rebound from these low trailing 12-month metrics, but not reach the 2012 averages that the company once obtained.
After analyzing the company's financials, we believe that it is important to note that Family Dollar's return on equity has seen significant improvement over the past 6 years, and that it is currently above the industry average of 28.6%.
So although we like the quantitative valuation of Family Dollar, we also like the qualitative value-creating activities that they're performing. This includes improving the logistics to their Utah distribution center and McLean partnership, as well as their purchasing directly from overseas suppliers for their global sourcing teams, as well as their increased marketing of private label goods, which have higher margins.
And through their employee training program, Family Dollar has reduced its inventory shrinkage as well as reduced its employee turnover rate. They've also increased store foot traffic with their appealing consumables mix, including the addition of tobacco products, as well as their renovated stores. All of these qualities make Family Dollar a strong buy. However, there are some risks to this recommendation. The first being economic uncertainty. The increase in payroll taxes, as well as rising gas prices, has burdened the Family Dollar consumer, reducing the amount that they can spend on high-margin discretionary items. However, we believe that there is an upside to this risk, and that is the potential increase in trade-down customers shopping at Family Dollar stores, as they look for value goods and to shop closer to home.
The second risk to this recommendation is the increasing competition that Family Dollar faces from big box retail, as well as the low switching costs associated with the industry. While these are risks to Family Dollar, we feel that the company is strategically positioned with their convenience factors as well as their store renovation program to negate these risks.
Third investment risk are their decreasing profit margins. However, we believe that Family Dollar is properly combating this issue through their increasing sales of private label goods, as well as the Utah distribution center, as well as their McLean partnership. So in conclusion, we believe that Family Dollar is a buy with a price target of $72.85 because of their growth through expansion and renovation, their position in the industry, as well as their expensive stock qualities and strong valuation. And now I would like to open the floor for questions.
What will it take to make the stock go up? I mean, it's great you got a target, but what's it?
We believe that one of the main reasons, there's a lot of negativity around margins in the industry. So we believe that there is going to be a shift in the norm for these margins, that gross profit margins are going to be lower due to the increasing amount of consumables. So once that takes hold within the industry and investors realize that this is what it's going to be like in the future, then we feel like they will value the company more due to the revenue growth that the companies will see due to more consumables merchandise being sold.
We believe they are focusing too much on the profit margin and not as much on the fact that they're offering goods that are going to bring customers into the store more often. So increased traffic will offset the lower margins by more volume.
You would argue that sales will grow faster and offset lower margins and earnings.
tax increase has gotten considerable publicity recently, especially with the stuff that's come out with Walmart in the last week and their concerns on sales. We feel that this is a risk to our recommendation. However, we feel that the payroll tax increase, which will burden the lowest income families, that will only continue, that will broaden Family Dollar's customer base, because the trade-down customers that might usually shop at Walmart or Target are going to be looking for even more value, and therefore they'll be shopping at the Family Dollar store.
As well as higher gas prices. One of the best things that Family Dollar does is their convenience. They're targeting customers within a 3-mile radius. So these customers, instead of paying an extra to drive to a Walmart, they're going to be going up to a Family Dollar and getting what they need.
Do you believe when they said they could do 20,000 stores? They don't have stores in California, but there's other people that have stores in California. You looked into kind of an industry saturation analysis.
This is the saturation analysis that we did. And so essentially what we did is we took the number of stores of both Family Dollar and Dollar General, who we feel are the closest in competition. We looked at the number of stores in each region, and we took the 2010 census, divided the number of stores by the people, and as you can see in the West, there's 93,000 people per store. So there's tremendous growth opportunity in that area. We used the South as our basis for our saturation point, and went conservative with 10,000, and then applied it to each of the other regions. And then we backed out Family Dollar's current market share compared to Dollar General, staying conservative, saying that they'll keep their same market share proportion. And we determined that the company can grow by at least 5,000 more stores. And we feel that this is a conservative estimate, just based on us saying that the South is already pretty much saturated.
Okay. And so 20,000 would just be great for you.
Talk a little bit about the debt on the balance sheet.
They have relatively low amount of debt, especially compared to Dollar General. They recently took on some to pay for stock repurchases. But other than that, the values of the company, they don't like to take on a lot of debt. And we can see through their balance sheet, it is decreasing just due to the principal payoff. But prior to 2010, it was even lower than that. So we feel like it's a positive for the company that they don't rely on debt to fund their operations. Though it is necessary during some times.
Do you know the percentage of debt on the balance sheet?
You go to the financial ratio. I don't know off the top of my head. I'll have to get back to you on that.
Okay.
I know it's not.
What are you actually estimating for earnings, current year or next year, whatever time period you want to address? And how do you get to that number, and by that I mean sales growth rate, what margin, what SG&A, what's happening with everything? So just kind of walk through those.
Okay, so if you go to the store forecast, please. Essentially what we did is we looked at the comparable store revenue. The way we calculated that was, so say we wanted to look at the comp store revenue in 2012, we took the revenue from 2011 and used that as our comparable store basis for the current year. So we grew that at our projected comp store growth rate, and then added in the additional stores that they were opening in the second to last line. And we used that to get a non-comparable store revenue. So we combined those, and then that was our top line. And you can see we used a conservative growth rate in comp store sales, 5.1%. The first quarter for 2013 was 6.6 for Family Dollar. So we applied 4.5 for the rest of the time periods, which we feel is conservative. But that's where we came up with our revenue forecast for the 1066. And then below that, in terms of our margins, we forecasted that gross profit would decrease just due to the amount of consumables that were being sold, and it has been increasing, so there would be more pressure. Though we had SG did a sensitivity analysis around net profit margin. That was one of our biggest risks right there is, if profit margin changes either way, that would significantly impact our stock price. So you can see we are slightly above 4.6%, and our PE price and our discounted cash flow price are listed there. And we looked and we thought, what if profit margins decreased by 10%? And that would put us around 4.2%, a little less than 4.2, which would still be a strong buy for the company. I believe that they would really have to try to drive down profit margins to where it would not be a buy as of now. But that is the sensitivity analysis that we performed, and it was comforting because even with significantly lower profit margins, we still felt like it was a buy.
And to compete against the lowering of profit margins, they've been enhancing their private label goods, which is really key to increasing their margins, as well as the multiple training employees, as well as the claim distribution center, making things more efficient to really help out with the bottom line.
I guess I'll ask about price to book again. I'm still not understanding why people value retailers on price to book. You guys can explain the theory behind that.
So we use that because it was a commonly used valuation metric in terms of other companies, just a way to value them. But a way that we looked at that, we did the enterprise to EBITDA, and that was essentially the leveraged buyout option. But we wanted to take a look at it. You didn't have to take on all that debt and buy up the debt of the company, what the price would be at. So we used that multiple just because it was widely used, and we felt like it was still an appropriate measure.
So did you take like the average over time? Or how did you get to the right number?
So we projected out, in our model, we projected out stockholders' equity for a year, we used that as the book value, and then we used our multiple and applied that, and then came up with our stock price.
And the multiple came from
That was, go to the...
historic or?
Well, it was historic, and we looked at, again, in that slide, the trailing 12 month was lower, so our consistent trend was to increase it slightly because we felt like it was undervalued now. So
So you're getting a little bit into the tautology. I think it's undervalued, therefore I'll raise the price to book. Right?
well, we didn't intentionally raise them to make our price. Is that what you're trying to get?
No, I'm not saying, what I'm saying is that how do you get to what the right price to book is for a company?
In terms of our well, that's where we looked at historical and saw the trends that it had been trading higher.
And it had been trending higher.
Yes.
So you were willing to raise it.
Yes, and then